So this week a becalmed market with a very low VIX sprung into life on Wednesday, when we saw a steep drop in the American markets as the market reached its tolerance point in terms of headlines coming out of the White House. So we've seen poor performance from the major European, US and Japanese markets, better performance from emerging markets and the FTSE, principally because of commodity prices have continued to rebound over the last couple of weeks. Here you can see the dollar, which has weakened against most major currencies, apart from the Brazilian real, which obviously got its own political issues that have come out this week. And there's been quite a lot of bond buying, particularly in the States, so that 10-year yield has fallen throughout the week. So we're now in a position where, as you can see here, from that 10-year has retraced a lot of the ground it made on this Trumpflation trade. And actually the dollar is now back to where it was pre the Trump victory. We've also seen a retracement of the outperformance of US small caps against large caps, which just shows a lot of that euphoria coming out of the market. A lot of that's been triggered by a very sharp reversal in the economic surprise numbers coming out of the States. So economic numbers have started to miss since March, quite heavily actually, having had a period of sustained outperformance. And so we're at a juncture where this Trumpflation trade has really been priced out of the market. So we're in portfolios here just reconsidering whether that is right and whether we can still see that growth coming through. And I think we do feel the Fed is still on track, as they iterated a couple of weeks ago. We still see those growth drivers coming through. So it's perhaps time to revisit that. In terms of the UK, Lloyds finally sold the last of its government stake this week, and here we can see the progression of this business since 2010, after the crisis, when the government bought in. We've seen a rebuilding of their balance sheet. Their CET1 ratio has gone from 7 to around 14%. Wholesale debt has fallen to zero. Countries they're operating has gone from 30 to 6, so they've really simplified the business. They've gone back to paying a dividend, 2.2 billion in 16, and the underlying profit has obviously gone back to a more stable level at 7.8 billion. Here we continue to see a lot of potential for further returns coming back to shareholders. They are producing around 200 basis points of excess capital per year, of which 70 basis points has been paid in ordinary dividends. So there's between 100 and 130 basis points to pay in special dividends or share buybacks, which we think will support and drive that price further forward for the shares. Looking at next week, key stocks for us will be Marks & Spencer's and Vonovia on Wednesday, and then Medtronic on Thursday. Just looking at Vonovia, this has been interesting because we've seen those German rental growth start to accelerate, as you can see here from this chart since 2011. That's just one aspect of this stock that we like. We like the relative price per square metre in Germany, which is around 6,000 euros per square metre, against something like 25 in prime London, 15 in New York, and around 10,000 in Paris. The rental yields that you're getting in Germany at around 4% against the Bund yield, which is around 0.35%, looks very attractive relatively. And finally, specific to Medtronic, which is a play on an ageing population, here you can see the acceleration in the US population that are aged over 65, which is going from 13 million in 1950 up to 89 million in 2050, which is really supporting their base proposition. So that's it from me. Thanks very much.